Unlock the secrets of DeFi earnings with today's deep dive in Immutable zkEVM rewards, where they mention providing liquidity will get you bounty. Whether you're new to crypto or a seasoned trader, this guide will clarify liquidity pools, tools like Merkle and Gamma, and even though we're using Immutable zkEVM blockchain and explaining the rewards as in the main example, these DeFi principles and strategies tips will boost your profits across any liquidity pools on other blockchains. In today's video, we're going to unpack the essence of liquidity, its crucial role in trading, and how liquidity providers keep the market moving, and automated market makers, AMMs, and dive into how people are making money here. Then we're going to dive into strategies, frameworks to help you select the best asset pairs, assess risk, and tips on how much to put in based on some guidelines I'm going to be providing. If you find videos like this helpful, hit that like button. It really supports the channel. GM to all the new faces and returning strategists. But before we cover everything, a quick disclaimer. I'm not a financial advisor. This is not financial advice. You can lose money with crypto and NFTs. Also, the crypto world moves fast. Always double check the latest updates before making any decisions. Now, let's dive into explaining everything. On the Immutable zkEVM rewards page, it says providing liquidity will get you bounty. And then it lists these two platforms underneath, Merkle and Gamma. To fully understand this piece of the rewards program, I'm going to need to explain a few things, especially for those who in the community who are new to decentralized finance or DeFi. We're going to break it down into simple terms so that you can easily understand and possibly get involved. This is an in-depth section, so you can always come back and refer to the time codes. I cover a lot and explain what a liquidity provider is, pool basics, how Merkle and Gamma work, and potential rewards, understanding important questions of how much I would recommend for beginners and which trading pairs to choose based on your personal experience. That is a lot to cover, but when you have an understanding of this, you'll be able to take this knowledge and apply it to a lot of other blockchains and make use of this, because not a lot of people are diving into this aspect of crypto, and a lot of crypto gamers are not in this as well. So there is a potential to know this and get in early. First, we're going to talk about liquidity. You've probably heard this term thrown out a lot in crypto, but let's dive into what this actually means. Liquidity refers to the availability of assets that can be easily converted into cash and traded without affecting the asset's price. In the world of crypto, liquidity means how easily tokens can be bought and sold at a stable price. So imagine you're going to be playing this game where you need to trade items quickly to succeed. Having high liquidity is like having a lot of players around, all ready to trade, making it competitive and making the prices stable so that the game is also more enjoyable and the economy is efficient. Liquidity providers are going to be people, individuals like you and me, who take their crypto and then they provide it into these pools, these DEXs, and these AMM. Blockchains that feature a decentralized exchange or a DEX, where we can swap out one type of cryptocurrency for another, like trading Ethereum into Immutable X. Unlike traditional exchanges, DEXs are decentralized, meaning that they don't have institutions or market makers like Wall Street does that facilitate stock trading. What they do instead is that anyone can provide cryptocurrencies to help create a robust automated trading market. This leads us to automated market makers, or AMM. An AMM is a type of DEX that uses a mathematical formula to price assets instead of using a traditional trading book, which is seen on Wall Street and with the stock market. The most well-known AMM is Uniswap on ETH. AMM allows digital assets to be traded automatically by using liquidity pools instead of a traditional market makers, and this system enables 24/7 trading, relying on users to fund the pool with their tokens in exchange for a share of the transaction fees. Now that we understand where liquidity providers operate using DEXs and AMMs like Uniswap, let's dive into how they actually make money from their contributions. Liquidity providers earn money primarily through transaction fees. Whenever someone makes a trade into the pool, where the liquidity provider's assets are all pooled inside, a small fee is charged. That fee is all then distributed to all the different liquidity providers who funded their assets into this pool as a reward for their investment and their contribution. Think of it as getting a small thank you tip every time someone makes trades with the items that you provided in a game. It's a way to earn passive income from your cryptocurrency holdings without actively having to trade them yourself. This system is crucial because it incentivizes users to supply their tokens and assets, ensuring that there is always enough tokens available for trading. Without enough liquidity, trades could become slower, more expensive, and potentially leading to massive price swings and price instability, which is something you do not want when people are participating in a trading market. But being a liquidity provider isn't without its challenges. The main risk is something known as impermanent loss. This occurs when the price of the tokens in the pool change compared to when you first put them in there, when you first deposited them. Imagine that you invest equal amounts of gold and silver. Suddenly, the price of gold goes up and your portfolio heavily becomes weighted towards gold. Normally, you're going to rebalance by selling some of the gold to buy more silver because you want to keep a balanced portfolio, keeping your investment spread and reducing your risk. So think of that concept. In cryptocurrency liquidity pools, a similar imbalance can occur where one token's value increases sharply compared to the other. The pool is going to automatically rebalance itself to maintain a constant value ratio, which can result in you owning more of a lesser value token depending on when the price increases. So this ratio is going to change the fluctuation of how much you own of each asset that of this liquidity pair. So it's just providing two different pairs of assets into the pool. And then based on price changes or price appreciations, crashes, depending on how much that is worth, your ratio changes. And this is what is most important in understanding a liquidity pool and where it does get a little bit complicated for new people. And if you withdrew your funds during this imbalance, this is impermanent loss, where the current value of your holdings is less than if you just held those assets instead. If you simply just held those tokens instead of participating inside this liquidity pool, you could have just avoided this loss and benefited more from the price increase of the more valuable tokens. So this is one of those risks that you just have to keep in your mind. Finally, we can talk about Gamma and Merkle, the two tools that were listed under the zkEVM rewards page, two tools that are designed to enhance your overall experience and rewards as a liquidity provider and support the AMMs zkEVM platform. I've already hinted at it a little bit, but what does Gamma do? Gamma is an automation platform that manages your cryptocurrency in liquidity pools. It adjusts your investment pairs to where they can best earn rewards and returns based on current market conditions with how their algorithm automatically adjusts things, which is game-changing for beginners so you don't have to learn all the technicalities of it. Yes, could being more accurate and knowing the nuances of how to actually manage your positions in these liquidity pools return higher returns? Potentially. But is it a lot of work? Yes, this just simplifies the entire process so you don't have to dive into that. That is another conversation for another time if you want to dive into liquidity pools and how to maximize your rewards. Now you're probably thinking, what does Merkle do and how does this relate to the overall rewards program? Merkle provides incentives beyond just the trading fees that you would get from people trading inside a liquidity pair. What this does, it enables platforms like Immutable to offer extra rewards, incentives to liquidity providers, motivating more users to contribute their cryptocurrencies. This boosts overall liquidity, ensuring that there's smooth trading, stable prices, and improves platform reliability, especially when a platform and a blockchain is new and they need people to provide liquidity, so they give extra incentives. Hint, hint. This is where Immutable is rewarding those who are providing as liquidity providers. Normally, the setup is going to be complex, but Immutable is making it accessible, but they don't provide any instructions. So that's where I come in to help you navigate this portion and talk about the nuances and help you go step by step. Gamma's going to manage the technicalities of liquidity, and then Merkle's going to boost your rewards. This is a great approach into DeFi and understanding and getting a feel for it that lets you maximize your earnings and engage in this dynamic upcoming gaming economy. So it's a win-win. Now, the big questions that you now probably have is, which pair do I pick? How do I get started? How much should I put in? These questions are deeply personal and it depends case by case. It's going to hinge on your financial comfort, your risk appetite, your market savvy. While you might want to go for the highest profit, it increases your risk. So first, we're going to tackle which assets are you going to provide to what liquidity pool. Instead of going directly to QuickSwap, the decentralized exchange, you're going to deposit it directly into Gamma for Gamma to manage your assets for you. But you have to pick which cryptocurrency pairs you want to put in, and you also have to know which ones are incentivized. So when you compare all of these crypto trading pairs together, it can be hard to figure out which ones to choose. And how I choose personally, I take a look at a variety of things. Fees, total liquidity, trading volume, and APR, which is essentially your rewards, annualized for your return for your ROI, your return on investment. And then I do rough estimates to figure out my potential ROI is. And this sounds very overwhelming for beginners, so I'm just going to simplify things to just look at the APR to see what the highest potential could be. And then you would choose a pair that matches your level of risk and belief in it. So here's a general framework that you can use to determine the risk level of each pair. And again, this is in a vacuum, so you need to factor out other things with it, like macro factors that I'll explain after this. Now let's add more depth to help you categorize and understand these pairs. Ultra conservative pairs, the example that I gave was USDC and DAI. This risk level is low, and the characteristics of this is both assets are stable coins that are pegged to stable values like USD, minimizing the risk of impermanent loss due to price volatility. And it's ideal for those who are extremely risk adverse and want something that's steady, predictable returns, but returns can be low because there's not big fluctuations, and there's a lot more people providing into these pools. Next is conservative pairs. The example I gave was ETH USDC. Risk level is low to moderate. This combines a stable coin with a reputable large cap cryptocurrency, reducing volatility, but does offer some exposure to potential crypto market gains since you have one of it inside a large cap crypto. In this case, it would be ETH. This is good for those who have moderately risk adverse tolerances, but want to seek a little bit higher returns than just a stable coin only pair. This brings us to moderately conservative pairs. So think BTC and ETH, lower risk level than moderate. This pairs major cryptocurrencies, which are less volatile than altcoins, most altcoins, but more volatile than stable coins with a large cap crypto combination. These market movements tend to be more correlated, so they tend to move with each other, reducing the extreme potential of impermanent loss. This is going to be suitable for people who want a balance between stability, but have potential for higher returns. And because without the high volatility of these lower cap altcoins that we're going to be getting into. Dropping down one level, we get to moderately risky pairs. The example that I gave was IMX to USDC. Risk level here is moderate. This includes a medium cap crypto with a stable coin, exposing investors to medium volatility and market specific risk, buffered by a stability of a stablecoin. It's going to be a more risky, highly volatile because you have a lower cap crypto, and usually the going down in value, market cap, the higher volatility that you're going to see, but the higher return as well. So this is going to be good for people who can handle market fluctuations and are looking for better returns than the more conservative pairs that we've already seen. Let's drop down even further. We go to high risk pairs. So think ETH, Immutable. This risk level is high because it combines a stable, more well-known crypto with a more volatile altcoin. And again, the lower that you go in market cap, the more volatile that it will be. But this increases potential for high returns, but also increases your exposure to impermanent loss because these can highly fluctuate in different pairs and in different degrees. And depending on how high one goes or how high the other one goes or drops, it'll rebalance, and you might be in a bad situation where you hold tokens that you weren't expecting to hold. So you get rid of your ETH, and then now you have IMX, or you could replace IMX with something else, and then IMX doesn't do as well as you thought, and now you have impermanent loss, and you have a bunch of these tokens, and your SOL, which I have been in the past, so that's why I'm telling this story, so you can learn from my mistakes. Which brings us to who is this best for? This is going to be best for those who can tolerate higher risk and have knowledge about specific altcoin dynamics and can monitor this, because monitoring this is extremely important so that you can get out at the levels that you need before you get wrecked. And finally, the last level for my degens out there, this is ultra high risk pairs. So you're going to think of new DeFi tokens, new gaming tokens that appear at the very bottom. These are not established. They're highly volatile. This risk level is extremely high. It involves low cap market, new project pairs, highly volatile, highly speculative. And this is only advisable for experienced traders with high risk tolerance and a deep understanding of risk management and these project specific risks. I do not recommend that for beginners. That is a broad level to factor in the riskiness of these different pairs, but always factor in market conditions and external risk. These are a few things just to keep in mind. You want to think about how volatile the pair is, or the individual pairs are, and how they could affect each other. The more volatile the projects, the more volatile the markets. This increases the risk for impermanent loss. Liquidity. Higher liquidity generally reduces the risk overall, but you have to consider how the liquidity might change with market conditions. In high liquidity environments, low liquidity environments, this is going to change how the tokens are affected. With massive crashes, with liquidity getting pulled out, as we've seen into going into bear markets, this are things that you have to understand and keep mind of, that you need to set your stop loss of where, when the market hits this part, you need to get out of your liquidity pools. So that comes with understanding the different pairs, which goes into a whole new section of risk management, but that's the general understanding that you would need to know. And then another important thing is historical performance. How has this performed in the past, this trading pair? Historical performance doesn't guarantee future results, so always remember that things constantly change and we run into unexpected market conditions, but history doesn't always repeat, but history does rhyme, which means that it might not happen exactly in the way that you think, but it'll be similar in some ways. So think about that and study the different pairs when you're getting into this and you want to dive into it more. Now, how do you identify which pairs are getting incentives? Which pairs Immutable is giving rewards for the IMX token? What you do is you hop into Merkle, and then you can see which ones. You go hop into Merkle, connect your wallet, and then you're going to go to the zkEVM drop down, pull that down. You can also go from the rewards tab and then just click on Merkle there. It'll take you directly here. But here you can see the 4 different pairs that they're rewarding. IMX, or wrapped IMX, which is WIMX, with GOG, which is Gilded Guardians, IMX and ETH, IMX USDC, ETH USDC. Let's start with WIMX GOG, which is wrapped IMX, Gilded Guardians again. This tops the list at the highest APR with 189%. This is a high risk pair due to both tokens being highly volatile and niche. So remember that. Next, we move on to WIMX and ETH. This follows an APR of 106%. This pair is still high risk, but less so compared to WIMX and GOG because their market caps are lower, and IMX ETH, the market caps are higher because ETH is a way well established in large cap crypto. So it's going to have reduced risk compared to IMX and GOG. Brings us to WIMX and USDC. This offers an APR of 101%, placing it moderately risky category because we have the inclusion of a USDC stablecoin, and that's going to reduce your overall volatility. And then brings us to our most conservative pair, which is ETH USDC with an APR of 95%. This combines a major number 2 cryptocurrency with a stablecoin, providing a more stable investment environment. But always remember that the crypto market does not function in a vacuum. It's affected by the overall markets and the overall global financial markets. So always remember that, and any changes there can directly affect crypto. Now you're just going to look at these 4 different pairs. You're going to look at your potential rewards, which is just your APR in this case, and then you're going to look at how much risk you want to take on for the rewards that you want to gain. Remember your investment time horizon. How long are you going to hold this? The macroeconomic conditions that are going to affect these decisions. So always remember that when choosing these pairs. Now you're probably thinking, how much? How much? These are the different guidelines that I follow. These are not hard and fast rules. It's going to depend on a lot of factors like I mentioned, but we don't have time to go over that. So if a friend just asked me what I would recommend starting on ETH, this would be $3,000 to $5,000. Yes, that is a lot. But this range helps counterbalance ETH gas fees. But the good news is on Immutable zkEVM, it has lower fees, so you can start smaller, especially now that in this period of time, they are actively rewarding and boosting returns. So the current APRs that you see right now, they are high. So you want to think of APR as your expected yearly return. It fluctuates, you're going to see that number change, but it's just a general estimate based on where we are with current conditions. Now, if a friend asked me how much I would recommend for Immutable zkEVM, here's what I would say. For beginners, or if you're risk adverse, I would still consider starting with about $500 to $1,000. Feel free to bump this on how much you put in based on how big your bankroll is. Make sure that this is not a significant portion of your overall portfolio, and how much risk you're willing to take in, and how new you are to this. If you are new, know that you're going to be making mistakes. When I first became a liquidity provider a while back, the money that I put in, I was willing to risk and lose because I didn't know and I didn't fully understand everything. So I went into this knowing that this is my payment for the knowledge that I'm going to get through experience. So now that we have a better understanding of the various pairs, which pairs do I suggest that you choose? If you're new and conservative, then WETH, USDC is a good option. If you're comfortable with moderate risk, then pairs like IMX, WIMX with USD might be better for you. And for those chasing higher returns who can stomach significant fluctuations, can monitor and stick to risk management, you can consider the high APR pairs like IMX and WETH, WIMX and WETH, or WIMX and Guild or Guardians GOG. That said, what I personally plan to do is I plan to invest $1,000 in IMX and ETH pair, depositing tokens on Gamma to let the platform handle the management and optimization for me. This, for me, is going to be a short-term to medium trade for me, and I only plan to do this for as long as the rewards program is active. So if ETH dramatically outpaces IMX, where the value of ETH dramatically gets higher, it's going to automatically rebalance my position to compensate, where I'm going to have a lot more IMX depending on how much ETH grows in value and price. And getting more IMX in my situation is something that I'm okay with getting because I believe that it'll be here for the longer term. But this can be extremely risky if one of the assets, say replace IMX with something else, can't survive a market crash, which is exactly what happened to me when I became a liquidity provider when I was a newbie a long time ago. This happened to me when I first added to an LP pool back in 2001. Market conditions crashed in May, as everyone who was in that market at that point can remember. You probably have PTSD from it, which led to significant impermanent loss for me that never recovered. Despite the allure of high returns in APR, it means nothing if you get more of a token that can never recover. So this is one of those lessons that I always keep in the back of my mind. There's always two groups of people at this point. People who get super excited that they've seen the matrix and they want to do everything to get involved and start diving into other platforms. And those are other people who are extremely overwhelmed because it's a lot of information. If you're on the latter half, you're overwhelmed, it's okay. I was too. It took me a while to understand this. Participating in Merkle and Gamma is not required, so feel free to skip this and just do the easier things in the reward program. I'm going to be doing more deep dives, going over a lot of different things, so subscribe if you haven't yet. And if you enjoyed this video, I think you'll like this video next. So click on it.